Welcome to the Deep Dive, where we take your source material and turn these really complex narratives into, hopefully, crystal clear insights. Today we are jumping into the enormous, high-stakes pressure cooker that is regulated finance right now. We're looking at some key excerpts from a piece called Open Systems, Verifiable Truth, why Metallicus extends the institutional narrative. And it frames this fundamental conflict. You've got institutions that are trying to close the story. You know, they want to keep their old systems, their old assumptions, because that feels safe. And then you have this other group that sees these structural facts on the ground and knows they have to move toward verifiable truth and really expand the story.
That tension is so palpable. And that's really our mission for this deep dive. We want to give you a shortcut to understanding what this next chapter of finance actually looks like. We're going to drill down into the technical and structural things that are just non-negotiable now. And we'll look at how this one specific architecture, Metallicus, claims to be the answer.
Okay, let's unpack this, because the source material is pretty adamant that this isn't about chasing trends. These are structural facts, things the financial sector just can't ignore anymore. So what's the first big pillar of reality they have to face?
The first one is standardization, a mandatory need for it. The whole world is moving toward one single standard, ISO 2022.
Okay.
And this isn't just, changing a file format. It's about demanding richer, structured data for every single transaction. The source basically says those old, opaque message formats, you just can't defend them anymore.
Right. So if you need cleaner communication, why do you need a whole new infrastructure? Like a blockchain? Can't a bank just, patch their existing systems to speak this new language?
That's a great question, and it really gets to the heart of the problem with old architecture. You can try to map old data onto a new format, but ISO 2022, it's asking for data that often just doesn't exist in the old systems.
I see.
It needs end-to-end traceability, a certain structure that really only ledger-based systems can provide from the get-go. So it's forcing them to modernize not just the message they send out, but the data they hold in.
So it's a structural change, not just a cosmetic one. Okay, fact number 2, this one hits home for everyone. Speed.
Yes.
We all know it's just not acceptable anymore for money to take days to move.
Yeah.
Instant payments have completely reset what we all expect.
Absolutely. The source points to systems right here in the US, like FedNow and RTP. These aren't just ideas, they're live networks that make real-time settlement a reality.
Right.
The old way was batch and reconcile. You'd move these big files overnight and then sort it all out.
Yeah.
The new world is atomic settlement. The whole thing, the payment, the confirmation, the final settlement, it all happens in seconds. If your system can't do that, you're pretty much out of the game.
It's like going from mailing a check to an institutional-grade Venmo, but, for billions of dollars, and with a regulator watching over your shoulder. Yeah.
Exactly. And that need for speed leads you right into the third fact. Tokenization is now operational.
This one feels like a bigger leap for a bank, though. Tokenization can seem so complex, so risky, especially with the whole history of crypto. What about the security risks they're so worried about?
And they should be worried. But that's why the context is so important here. The source isn't talking about Wall Street speculation. It's pointing to credit unions and community banks that are already piloting real stablecoin use cases.
So it's already happening at the community level.
It's happening. They're integrating tokenized value into their day-to-day. And that suggests the risk is being managed by putting these assets on compliant, controlled networks. It's moving out of the lab and into the real world.
Which brings us to the last piece of the puzzle. Fact number 4. Which is all about compliance and trust. The regulators are demanding total clarity.
This might be the biggest driver of all. The source talks about ledger-level transparency, provenance, and auditability. These things used to be a nice-to-have, a sort of technical preference. Now they're becoming a mandatory compliance thing. Regulators want to see where the money came from, where it is, and where it went, and they want to see it instantly.
So if you can't provide that clean, immutable trail, you're in trouble.
You are. Your system is just going to buckle under that kind of regulatory scrutiny.
So if we tie it all together, these 4 facts, you have ISO 2022 needing better data, FedNow demanding instant speed, community banks using tokens, and regulators demanding transparency.
Right.
It sounds like you really do need a whole new chassis, not just a new coat of paint.
Exactly. And that's the choice institutions are facing. Do you keep trying to close the story on old tech, or do you build something that actually fits these new facts?
Which brings us right to the architecture. And this is where it gets really interesting, because the source makes it clear this isn't about replacing banks. This is designed to extend what banks and credit unions can do. So how do they do it?
Well, it all starts with the foundation. The sources describe the metal blockchain as the underlying fabric. And the most important words there are permissioned and compliant.
Permissioned. So not just anyone can join.
Exactly. For a bank, that's non-negotiable. You have to control who is on the network, who can transact. It's essential for things like KYC, AML, all the regulatory requirements. It's built in from day one.
Okay, so the blockchain gives you that verifiable, immutable record, but you still need an engine to actually run the complex stuff on top of it, right?
You do. And that's the job of the A-chain and PulseVM. This is what they call the deterministic execution layer.
Deterministic. What does that mean in plain English?
It just means the outcome of any transaction is 100% predictable and auditable. Every single time. If you put X in, you will always get Y out, which is, absolutely critical when you're a fiduciary.
Got it. It's reliable. And it's built specifically for those institutional jobs, like issuing stablecoins you mentioned earlier.
Exactly. Or verifying identity in real time. It's purpose-built for that high-stakes environment.
Okay, so that handles the speed and reliability. But what about the actual money, the assets being moved? The source talks about the metal dollar, or XMD.
Right. So XMD is designed to solve a huge problem in tokenization, which is fragmentation. You could have a world where every bank issues its own stablecoin, and liquidity gets messy and siloed.
A digital mess.
A total mess. XMD is described as a reserve-backed index. Its purpose is to unify that institutional stablecoin liquidity. It's like the common, trusted digital dollar that all the institutions on the network can use to settle with each other easily.
So it's the agreed-upon digital cash that makes everything interoperable.
Okay, so moving beyond just payments. What about new services? You hear a lot about DeFi, decentralized finance. How does this let a bank get into that world without the Wild West risk?
That's where MetalX and the loan protocol come into the picture. They provide the rails for compliant DeFi. And the key word, again, is compliant.
It's not open to anonymous users. Not at all. It has built-in auditability, risk controls, all the institutional grade stuff. A bank might want to get into lending with tokenized assets, but only if the regulatory risk is solved at the protocol level. This claims to provide that bridge.
So you build the guardrails into the technology itself. You don't try to add them on later.
You have to.
What about the customer,
Yeah.
the bank member? How do they interact with all this?
That's handled by the WebAuth wallet. And this is how the architecture tries to balance institutional control with what people expect from digital tools today. It gives you secure, user-controlled identity. So the bank gets its compliant transactions and auditable records, but the member keeps control over their digital identity and their assets. That's a huge deal for consumers now.
Okay, let's pull all these pieces together. You have the metal blockchain, the A-chain for execution, XMD for liquidity, the compliant DeFi layer, and the WebAuth wallet. It all converges into what the source calls the TDBN, the digital banking network.
Yes.
What does the TDBN do that the old systems just fundamentally cannot?
The TDBN is the glue. It's the vertically integrated network that connects the old fiat rails, the new blockchain rails, and the bank's own core systems. Its job is to handle all that complexity in the back, so the front end is simple and compliant.
So you can modernize without having to rip and replace everything.
That's the idea. Modernize without jeopardizing the trust you've already built.
Now, the sources claim this gives you huge operational advantages.
Yeah.
What's the biggest technical truth they offer? What can this do for a credit union that their current system can't?
The big one is atomic settlement and superior reconciliation.
Okay.
Tokenized balances don't just settle faster, they settle atomically.
No.
That means the payment and the final settlement are one single simultaneous event.
So there's no gap.
No gap. And that almost completely eliminates reconciliation risk. Think of all the money and time banks spend trying to match up transactions after the fact. That just it goes away. The source argues these balances audit cleaner and they integrate better with ISO 2022 because the truth is baked in from the start.
That's a massive benefit. But architecture is only as good as its adoption. Are institutions actually using this? Especially the community banks and credit unions you mentioned.
The source is pretty specific on this. It says more than a dozen U.S. credit unions are in active pilot programs with Metallicus. So this isn't just a white paper. This is, boots on the ground testing by real fiduciary institutions.
And it's not just individual institutions, right? It's happening at a higher level, too.
Yeah, exactly. The source also points out that national associations representing hundreds of institutions are aligning with them for education, for integration support, for regulatory guidance.
So that's just a broader market validation.
For sure. It means the architecture is gaining trust as a viable modernization path, especially for those institutions that really value that member trust and their own autonomy. It shows this idea of embracing truth is catching on.
Okay, so let's bring this back home for you, the listener. The core message here seems to be that a stack like the TDBN is becoming the preferred way for community banks and credit unions to modernize, but without giving up compliance or sovereignty or that trust they've built with their members.
That is the key insight. All those architectural details we talked about, the permission chain, deterministic execution, the institutional dollar, it all serves one goal.
Which is?
Proving to regulators and to members that you can build the next generation of finance while holding on to the highest fiduciary standards. It forces every institution to ask a question.
Yeah.
Are you holding on to old workflows because you fear these new facts, or are you building the infrastructure that embraces verifiable truth?
And the evidence here suggests that second group is growing. So to synthesize this whole deep dive, the story of finance is shifting. It's moving from closed, opaque systems to open, verifiable, real-time architecture.
And it's being driven by things that are non-negotiable now, like global data standards and instant payments. The proposed solution is this vertically integrated network that uses tokenized assets because they are just fundamentally better for auditing and settlement.
That leads perfectly to our final thought for you to explore on your own. If the source is right, if tokenized balances are inherently superior for auditing and settlement, what are the long-term implications for our traditional non-tokenized deposit systems?
And if that ledger-level transparency and atomic settlement becomes the mandatory baseline in finance, where else could that spread? Think beyond just payments. Could it apply to mortgages, insurance, all these other complex financial products that have always been kind of opaque?
The move from closed assumptions to open, verifiable truth isn't just a tech upgrade. It feels like a philosophical reset for finance. And for the institutions ready to make that shift, it looks like the next chapter is already being written. Thanks for joining us for the deep dive.